Corporate foreign income taxes. Well, when a U.S. corporation earns income from foreign sources, which for big companies, I mean, this is pretty common, right? It's foreign markets are great places to get additional income. It may be subject to taxes in the foreign country as well as in the U.S. Now, in order to avoid double taxation, the U.S. tax code allows corporations to claim foreign income taxes paid either as a deduction or a credit, depending on which option is more beneficial for the corporation. So yeah, you just got to know U.S. companies have the option of choosing either, and I'm sure they're going to have a tax team that is going to plot out which of these paths will be more preferential for them. They'll run the numbers, crunch the numbers, see what's going on. First off, as a deduction, if a corporation chooses to claim a foreign income tax as a deduction, it's going to reduce its taxable income. This approach could be advantageous if the foreign taxes paid are relatively small, or if the corporation isn't in a lower U.S. tax bracket. We're not going to have to answer questions on which is better to choose. I mean, we'll talk about it, a little bit, but nothing too crazy. And if it's a credit, if a corporation chooses to claim foreign income taxes as a credit, just as normal credits work, it's going to reduce the U.S. tax liability directly dollar for dollar. The foreign tax credit is generally more beneficial than a deduction, just as credits are generally more beneficial than deductions, whether it's individuals or corporations or anything, because they're going to provide a dollar for dollar reduction in the corporation's U.S. tax liability up to certain limits. However, the credit cannot exceed the U.S. tax liability on foreign sourced income, basically meaning it can't be refundable, which is calculated by applying the U.S. tax rate to the corporation's foreign sourced taxable income. All right. Yeah, nothing too crazy. Just introducing you to these concepts. We've got an example here, and again, it's not like you have to do this for a sim or anything, but we're just seeing how this works. We've got a U.S. corporation with the following financial data. We've got some U.S. sourced taxable income, and then it looks like we expanded our operations, went international. We got foreign source taxable income, and here's our total taxable income. Pretty sure you could have done that yourself, but here it is conveniently laid out for you. The U.S. corporate tax rate is 25%, and we've got foreign income tax paid of $40,000. Everyone wants to get their hands on your money, whether it's foreign entities, foreign governments, or the good old domestic government we got here. How is this going to play out if we've got a deduction? Well, first we're going to take our total taxable income of $500. We're going to say that our foreign income tax deduction is $40,000 because that's what we paid. And why would you have to pay, in essence, triple taxation, right? If you're a corporation, you're paying tax on your income, you're paying foreign tax on your income, and then the shareholders are going to pay tax on the distributions through dividends. So we see that why that's a problem there. I think double taxation or even single taxation is a problem, but I don't get to make the rules. So what is our adjusted taxable income? It's $500,000 minus the $40,000 of the foreign taxes paid, giving us $460,000. And then our U.S. tax liability is just going to be simple calculation, $460,000 times the tax rate for $115,000. Now let's compare that to see how a credit works. We've got our total taxable income again of $500,000. Now what we're going to say is, what is the U.S. tax liability before the credit? Well, the U.S. tax liability before the credit is going to apply that 25% tax rate to the $500,000, giving us $125,000. Let's see, the foreign tax credit. This is limited to U.S. tax liability and foreign sourced income. Well, we got $200,000 of foreign income. Let's apply the 25% U.S. corporate tax rate there, and that's going to be $50,000. Now, since the foreign income tax paid of $40,000 is less than the $50,000, the entire $40,000 can be claimed as a credit. As such, what's our liability after the credit? Well, our initial liability was $125,000 minus the $40,000, giving us $85,000 of liability. Now, as we see in this example, claiming the foreign income tax as a credit results in a lower tax liability compared to claiming it as a deduction. And yeah, a lot of times we'll see credits be more beneficial than deductions, but this is kind of playing it out how it would work. Therefore, the corporation would likely choose to claim the foreign income taxes paid as a credit. Very good, very good. Moving on. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.